Okay, good morning, everybody, and welcome back. Our next presentation is going to be from TECSYS. Joining us this morning, as you'll see on the screen, is Peter Brereton, the company's CEO. I will be your moderator this morning. Just to reintroduce myself, my name is Nick Agostino, and I'm the Diversified Technology Analyst here at Laurentian Bank Securities. Before we get started, just a reminder to please have your microphone on mute and your camera, make sure it's turned off during this session. Please ensure your name appears on screen so we can properly address any questions you may have. And should you have a question, please use the hand feature on your screen or submit your question by using the chat. We'll get to that question as soon as we can. Just so you know, questions will be moderated by Jordan Simon, and he will also handle any technical issues during this session. So with that, we'll get started. Peter, I just want to welcome you again this morning. I do appreciate not only your attendance today, but certainly your long-time attendance for all the conferences that we've been hosting. So again, appreciate your attendance and look forward to having this discussion with you. So Peter, if I start with my first question, and so this is a question that we're asking a lot of companies today, especially within the supply chain industry. So now that we're 2 years into this pandemic, when you look back, what would you say that you've learned about your customers and the marketplace you participate in, specifically the healthcare and the retail space? So what have you learned that maybe you didn't know 2 years ago pre-pandemic? And on the flip side, what do you think your customers and prospects that you're speaking with, what do you think that they have realized over the course of this pandemic that puts you in a stronger footing as we come out of this pandemic?
I mean, I think what we've all learned is, and it's kind of a stating the obvious, but just how fast things can change. I mean, you tend to look at sort of long-term predictions. If I go back a couple of years, predictions about what percentage of the consumer dollar was going to be spent online over the next 10 years. And you can see it sort of slowly rising over a 10-year period or whatever. And all of a sudden the pandemic hits and like, boom, 10 years of change happens in 3 months or 4 months or whatever. And one of the things that highlighted to me was there are companies that we were already dealing with that were in effect either on the curve or ahead of the curve when the change hit. They had already adapted to, if they were a brand owner, they'd already adapted to go direct to consumer. If they were a hospital network, they had already put the basics in place of a good supply chain platform. When that massive change hit, they were well prepared to deal with it. We could accelerate projects with them. I think of, Red Wing Shoes, for instance, they were already well down a path. The pandemic hit, suddenly sort of many consumers switched their purchases to online. They just accelerated everything and coped with it beautifully. Columbia Sportswear did the same thing, accelerated the rollout. Everything was very, very successful. Companies that are lagging the curve, though, and are not keeping up with changes happening in supply chain, they were almost knocked out of the game. I mean, because you can't, if you're already behind the curve, you haven't invested in a platform necessary to cope with change. Then when a tsunami hits like the pandemic, it's too late to catch up. You just are left with sort of a whole PowerPoint full of regrets. So that's, that was pretty obvious, and we could see it across the various markets. Hospitals, again, were a classic. I remember talking to one hospital client who, and they were, I said to you, I hear you're looking at accelerating the rollout. They said, absolutely. They said 3 months into the pandemic, we're realizing that it is only the places where we've deployed your platform where we actually know where our stuff is. And, in the other areas of our hospital, we're scrambling, we're trying to find supplies. We've got staff going out sick, and meanwhile, the staff that are there can't even get the supplies they need to look after the patients. So, again, it sort of goes without saying, but preparedness and a good platform that gives you agility and real-time sort of, one pane of glass that lets you see the entire situation end to end in your supply chain pays off in spades once you're into this kind of a monumental change. The impact we saw, and pardon the long-winded answer, but the impact we saw on the customer side also related to sort of a change in pressure points, if you will. I'm probably saying that wrong, but you know, the board of directors used to, in the hospital networks, used to be sort of the group that needed to be convinced to invest in supply chain platforms. And management, we could convince the management team would go to the board, and the board might say, well, no, actually, we're thinking of building another hospital first or whatever. The pandemic turned that around, and we now have the board saying to the management teams, in effect, why aren't you, you know, further along in your supply chain platform deployment? So it sort of shifted the focus right up at a board level. And I mean, there's a lot of pressure on boards these days to do a good risk analysis and manage risk, be it cyber risk or whatever the various types of risk are. And supply chain risk is now one of those risks that boards are being asked to keep an eye on and make sure there's a strategy for, and so on. So it plays very well into what we do. I mean, as you and I have talked about before, Nick, nobody puts in a platform like ours for fun or to gain some small little advantage or whatever. Like, this stuff is open heart surgery on the business. It doesn't happen unless there's a compelling need. And the pandemic just created or highlighted compelling need right across the board.
So it sounds like your the pandemic helps prove out your value proposition. Those that installed it come out ahead, and those that did not install it, they learn the lesson and obviously prepare for the next time.
Yeah.
Very good. So my next question is, and this was rather timely. We saw, I think it was last week. So on March 28th, you guys made an announcement where you added, I think you guys coined it as a store as a warehouse application that you added to your Omni solution suite. So can you talk about how that fits into your overall platform and maybe the revenue generation prospects that you guys see from that new module offering?
Sure. There's two parts to this, right? But this really has everything to do with a wide variety of both retailers and brand owners wanting to get into the same day delivery game. So there are many locations, particularly in the US, where the city is large enough, the population density is high enough that it is economically viable to offer same day delivery. You know, I'm working on a project in the morning in my house. I realize I'm missing a tool or something or other. I point and click on my phone, I order it, and it shows up 3 hours later at my door. So, but the problem is you can't do that if you're managing all your fulfillment out of two large distribution centers, you know, one on the East Coast and one on the West Coast. You really need a micro fulfillment strategy. There's two ways to do that. You can either, if you've got a large chain of retail stores, you can use the retail stores as in effect, as your local warehouse, if you will. And we already have supported that for the last few years at a low volume level. So we have an application that runs on the phone, just any Android or Apple phone, iPhone, and the store associate can get the order and pick and pack and ship the order right off their phone. But as the volume starts to rise, that starts to not work so well. So we've added this store as a warehouse application that gives you a very simple way to deploy a complete receiving, put away, pick, pack, ship, cycle count functionality where you're using store as a warehouse. The secondary application, though, is for the brand owners that don't have the retail stores, but they want to open 50 or 60 micro warehouses across the country where they can stock the 20% of their products that equal 80% of their orders and do that same day delivery in various areas across the country. We see this as sort of a third potential leg of growth for us. We've got, right now, healthcare is very, very hot. It is leading our growth. There's no question. Our general complex distribution platform, which is sort of a distribution focused ERP, it's also showing a lot of signs now of heating up as we're coming out of the pandemic. But this is sort of this move is sort of more one of our long game moves where we're seeing a trend over the next few years to this. And we think sort of 3-4 years from now, this micro fulfillment game is going to be a pretty hot part of the market. So we're trying to make sure we're getting there first, that we've got a sort of a first mover advantage in that market. And we're trying to sort of, in the next year or two, I don't expect the revenue from this to even be material. But I think if over the next couple of years, we can get 10 or 15 of these installed and operating and successful, we should be in a very good position then, as if this move continues that we think is coming, to go after that broader market. So we think sort of 3 or 4 years from now, this could become a pretty major growth driver for us.
Okay, so interesting concept. As you said earlier, you're turning stores into micro warehouses. I will add, I remember hearing a couple of years ago the idea of having trucks stocked with daily household items and driving around people's neighborhoods, so that as people put orders in, you can get that stuff within half an hour to an hour. And it sounds like this concept is somewhere in between that. So the warehouse, if you will, is getting closer and closer to people's homes.
Yeah, absolutely. Yeah, there's a number of companies in the convenience store business that are experimenting with that sort of rolling convenience store concept. Right. You're out, working on your deck, and you suddenly decide you need a Diet Coke. It's click, click, and the Diet Coke and the bag of chips shows up 10 minutes later.
Okay. So now, next question is, given the large TAM that you guys have in both the healthcare and in the retail space, and the growth potential within each segment, when you look at the current world we're in from an investor perspective, we've kind of gone from, at least in technology, from sales focused, growth, to more of a balance between sales growth and EBITDA margin and profitability and free cash flow. So maybe, given the change that we've seen in the marketplace, how are you guys looking to position TECSYS more in the short to medium term? Are you looking to maximize EBITDA margins, or are you going to stay, I would say, steadfast to what looks like the current plan, which is more of maximizing organic growth?
I mean, in a certain sense, I think we've never been totally in fashion on this point. When the market was all about maximizing organic growth and sort of saying, screw the profits, just grow. We never really bought into that. We've always maintained solid organic growth and a reasonable profitability. And the market mood, I know, has now sort of shifted the other way. We continue to focus on, good organic growth and decent profitability. And our thinking on that really is, again, we play a long game, right? Like our customers that come to our platform tend to stay on the platform for 20 to 25 years. They need to see an income statement and a management approach that gives them comfort and confidence that we're going to be there for many years, particularly in a SaaS world. I mean, our new accounts are now all pure SaaS. I mean, they are putting their core business, we're not a CRM or an email system or something like that. I mean, they are putting their core system of record onto our SaaS platform. So they absolutely need to have confidence that we're going to be there, we're going to be solid, and we're going to be there for the long haul. So that's so we just continue to maintain that approach. And if you look at our overall growth, it's been edging up over the last few years. Our SaaS revenue is growing at sort of 45% a year right now. As the SaaS revenue becomes a bigger and bigger piece of the total pie, it's going to drive up the total organic growth, as it becomes a bigger piece of it. But by managing to keep, EBITDA in the, let's call it the 8 to 10% range kind of thing. I mean, I know we overshot that last year, but, trying to keep it kind of in that 8 to 10% range, it just means that we're completely self-funding. We can continue to pay a small dividend. We don't need to rely on capital markets to sort of fund the growth. We can self-fund as we go. When the opportunity is good, we have sometimes raised capital to fund acquisitions. The last year or so, acquisitions have looked very expensive. So we've sort of sat on our cash there, but that opportunity, that situation might be changing now. We'll see. But so yeah, in answer to your question, the focus is, we see an opportunity to drive the hospital market. We're just about to blow past 50 networks We think we can get to 100 networks within the next 4 years. If you look at the SaaS revenue out of that market, we think we can get it close to 100 million in SaaS revenue over the next sort of 4 to 5 years. And if we look in the general distribution market, it's a huge TAM. The TAM is $6 billion. And there's that market is heating up too. So it looks as though we can continue to drive very strong SaaS revenue growth, which over time will pull up the total average growth, while still maintaining profitability at a level that allows us to fund our own growth.
Oh, very good. So it basically sounds like just focus on your operations and let the market do what the market wants to do.
Yeah.
So the next question, I think, somewhat, just in the context of the geopolitical situation that we're seeing between Russia and the Ukraine, and quite possibly what comes out of it between China and Taiwan in the future, we're certainly hearing more and more chatter around onshore production, from various countries. So your opinion on this, do you believe that this onshoring mentality will alter the flow of goods in the future? And if that is the case, what impact do you think that would have on your business? Is it going to be something that's positive, negative, or maybe neutral?
Yeah, I mean, for us, it's positive. I mean, it sounds terrible to say it in a way, because I know that there's a lot of lives and people affected by these kind of changes that are it's very difficult and tragic for many people. The thing is, though, for our business needs change. As I mentioned earlier, nobody puts in our kind of system for fun. So you need change happening in a market, and a long-term static supply chain that can be set up and run for 20 years with virtually no change. We know where those supply chains go. They go into SAP. So for us, we need people to need agile supply chains. And because that's our game, like because we're a pure agile supply chain platform with, strong traceability. I mean, we support the ability to trace product all the way from sort of point of manufacture right through to into the hands of the consumer or final use in a hospital or whatever. Those are all the kinds of things that people need in uncertain times, where they've got sort of new vendors arriving every month because the other vendor suddenly is no longer accessible, and so on. It's one of the reasons why we've always done so well in wine and spirits. We've done well in hazardous materials. These are markets that are changing rapidly. So we need change. So I mean, right now, the whole geopolitical situation around the world is people are realizing that a very long supply chain that spans one side of the world to the other is not necessarily a safe, predictable supply chain. So suddenly there's a lot of look at onshoring. There's look at diversification. I mean, that was a big lesson out of the hurricane that hit Puerto Rico. A lot of hospitals had 2 or 3 suppliers for certain products and thought their supply chain was diversified. And then the hurricane hit Puerto Rico, and they realized that all 3 suppliers had manufacturing plants on the same street in Puerto Rico. So much for diversification. They lost their, all sources of supply. So there's a lot of focus now on supply chain resiliency and diversification. At the same time, there's a recognition that the platforms that, the vast majority, 95+% of companies are running on, were implemented in time for Y2K. And these are 20-year-old platforms that can't possibly cope with the kind of flexibility and resiliency that is demanded, and as well as regulatory compliance and traceability and all these kind of things. And, cyber risk managing, resisting ransomware, all these kinds of things, those platforms were not designed for. They just, they didn't even think about those things back then. So those platforms need to get replaced to deal with, these new technology challenges, as well as the geopolitical challenges you raise. So for us, change is a key driver in our business.
Okay. I guess switching gears and talking about system integrators, and I know it's a topic that's come up a few times on conference calls, certainly from myself. I think system integrators can have a great influence on organizations of your size, and I'm sure we both agree on that front. So can you talk about where system integrators are today as far as influencing not only your top line, so your sales growth, but also the pipeline of opportunities coming forward. And then also speak to how you're trying to engage more and more system integrators to help you guys convert the backlog that you have already in place to also help when it comes to sales acceleration.
Yeah, I mean, it's a key factor. I mean, 3 years ago, we track in our pipeline what percentage of the opportunities in our pipeline are partner influenced. And what we've realized is that, that number just keeps growing. I mean, we can see it in there. So 3 years ago, we were at 0% partner influenced. 3 years later, we're at 28% of the opportunities in our pipeline are partner influenced, which interestingly enough, tends to translate into about 35% of the opportunities we land being partner influenced, which tells you that a partner increases your odds of landing the deal. Because the win rate, it comes through higher on the partner side than even in the pipeline. So that, those are all very good indicators. We believe that over the next 5 years, we'll get to a point where at least 30% of the opportunities that we are landing on a regular basis are literally brought to us by partners. That's now happening in the hospital space. Even though it's a fairly defined space, we know all the players. There's still a lot of action sort of on the ground that we can't necessarily keep track of. And we've now got, for instance, we have one partner in that space, Rise Now, that is growing rapidly, literally on the backs of our platform. I mean, they're installing it. They're coming to us with new opportunities. Hey, we're working with such and such a network. They really need your point of use solution or whatever. So that they are becoming a key driver in our market penetration in that space. At the same time, they do a fantastic job of managing all the stuff that is much closer to the customer side of the project. Change management, training, project management, managing the budget, helping the customer clean up their item master file. All these kinds of things they can look after. We're still involved in each project, but it allows us to focus our efforts on, sort of actually just configuring the software, setting it up for the client and doing a handover kind of thing. So as a result, it takes a lot of the governor off our growth. I mean, a limiter on our growth has been our ability to grow a professional services team rapidly enough and with enough knowledge to, do successful implementation. So it's a great flywheel. I mean, we continue to see that, and it looks like it's becoming a major contributor to our growth. Complex distribution is behind it. There's no question. Behind the healthcare side, we've got some more work to do there. We've added, we've now got 2 full-time people just working on building out partners in that space. We've got 1 great partner in the space. It looks like we're very close to getting 1 more. We're going to continue to add to that. I think we need to get to at least 4 or 5 partners in the complex distribution space, but I think we'll at least be at 2 very soon. Workday also continues to be an ongoing, significant partner, but they don't help us with our implementations. We're interfaced in the cloud, and it means we can go into a hospital and offer a complete solution, including back office as well as supply chain.
And if I could just, I think in that whole response, when it comes to healthcare, obviously that market's coming back as we come out of this pandemic. You talked about, I think in the past, system integrator support. Can you highlight, and you and I have had this conversation, how hospitals have also jumped in to help you guys on the system, on the integration side of things. Where are we? Last I recall, you had 1 hospital that was helping you on integration. Are there other hospitals that you've seen on a regional basis that are putting their hand up to help you on integration that's going to help, that flywheel you spoke about go even faster on the healthcare side?
There is. I mean, Mayo Clinic, for instance, is looking at it right now. They're looking at putting together a team that will go out and assist with, TECSYS implementation. I mean, part of what this is we have long been a product. What we're investing in right now is, in effect, moving from being a product in the industry to being a platform in the industry, where not only do we make money implementing this thing, but so do a whole bunch of other people. So you end up with a lot more stakeholders that are moving it forward and really creating an industry platform. And I think we're making good headway on that. But we'll see how it goes. I mean, the challenge right now in healthcare is there is so much need for supply chain and supply chain work that, I mean, one of the guys in the hospital space who has set up a small consulting team to do this, is he said he doesn't even need sales guys to sell it. you said, it's like it's like selling alcohol during Prohibition. It's there's just a lineup, right? So it's we'll see where that goes. There's pretty hot demand, so I mean, I think I think Mayo will be quite successful with it, and there may be others after that. We'll see.
Okay, and I know we're out of time, but I do want to get one last question in. So, in 1 minute or less, just foreign exchange, it just looks like it has quite the impact on your quarter-over-quarter results, whether it's on the revenue side and on the EBITDA side. And I know in the past, you guys did have a quasi hedging practice between using the spot market and hedging. So using the spot market for half and hedging the other half, I think on a little bit of on a forward basis. Is this something you guys are revisiting, looking to change and maybe try to dampen the influence associated with the FX, or are you just going to stay the course?
I mean, we're more or less staying the course. I mean, we've gone from sort of just a very predictable strategy of sort of hedging every quarter, for the next 3 quarters, 50% as you described, to being a little more opportunistic about it. Mark Bentler keeps a sharp eye on that. If the currency suddenly moves in our favor, we'll snap up another sort of chunk of hedging. So that has improved our, that's had a positive overall effect, but you can't hide from it indefinitely, right? It is what it is. So, last year, the Canadian dollar or the US dollar was very strong in 2020, I guess it was. So that really boosted our revenues. The last year, it's kind of reverted. So that's now put a dampener on revenue growth. It looks like we're kind of out of that. We're back into a more stable stage for a while. So I think it'll kind of fade from news, for the next little while. But we more or less continue that kind of strategy. You can delay the impact, but in the end, we're still a company with 75% US revenue and 75% Canadian costs. So you can't hide from it forever.
Fair comment. Okay, well, that's all the time we have for this presentation. Peter, again, I thank you for your time and your ongoing support with this conference. I want to thank all the attendees today, and just a reminder, we'll have our next. It'll be a panel conversation that starts at 10 a.m. this morning, and it's going to be a combination of hybrid ITSPs and system integrators on this panel. So stay tuned for that. And again, Peter, thank you so much.
Thanks, Nick.